Hi, my name's Christian Waldegrave, Head of Research at Teekay, and this is our conventional tanker market update for May 2016. Well, during May, the mid-sized tanker rates, the Suezmax and Aframax rates, they softened a little bit from where they were in March. The Suezmaxes came down to about the $25,000 to $30,000 per day range, and the Aframax is down to about $20,000 to $25,000 per day. And it's really following a theme that I think we saw in Q1, in that the rates are generally good. They're certainly well above where they were in the period 2009 to 2014, but the rates are a little bit lower year on year. And I think what's happening is that the underlying supply-demand fundamentals are still very good, but there are some seasonal and one-off factors that are impacting on rates. So starting with the fundamentals, oil supply continues to be very high, particularly from OPEC. In fact, OPEC production in April was at a 4-year high, and that's really being driven by the Middle East. Other parts of OPEC are seeing production going down, places like Nigeria and Venezuela. But in the Middle East, we're seeing production go up, and particularly from Iran as they exit from sanctions. In fact, last month, Iran produced about 3.4 million barrels per day, which was the highest since the sanctions were put in place in 2012. So all that OPEC production from the Middle East is very positive for ton-mile demand, because those countries are generally far away from the main consuming regions in North America and Europe and Asia. On the flip side, in non-OPEC, we've seen oil production come down quite rapidly, particularly in the United States, where we've seen oil production dip below 9 million barrels per day for the first time since 2014. And that's meant that the US has started to import more crude by sea, which is quite positive for tanker demand, and in particular the Suezmaxes, which carry that crude from West Africa and from the Mediterranean region across to the US. And we've also seen some outages in other parts of non-OPEC as well, parts of Latin America and so on. And again, that's all good for tanker demand. On the oil demand side of things, we've seen some very positive demand numbers. Certainly in the United States, they're gearing up for a very strong summer driving season. The EIA thinks it could be a record gasoline demand in the summer in the US. We're also seeing good oil demand from India and China as well, which is really driving that long-haul demand for tankers. So the fundamentals still appear to be pretty good, but what's changed a little bit is a couple of seasonal factors. I think we had a pretty mild winter, which affected rates through Q1. We also saw that the oil prices come up since the start of the year. Oil prices hit a low of about $27 per barrel in January, and they're now up to about $45 per barrel. And that's then translated into higher bunker costs. So bunker costs have actually gone up about 65% since January. They hit a low of about $125 per ton in January, and we're now just over $200 per ton. So that certainly eats into the earnings when the bunker price comes up. And we've also seen some heavier than normal refinery maintenance, because a lot of refineries which had good margins last year decided to defer some of that work as long as they could, and now they're having to go back and do that essential maintenance. So that's just lessened demand for crude a little bit through the last few weeks and months. Looking ahead though, we do think the rest of Q2 looks pretty positive. In the next few weeks, we should see all of the Asian refineries that are now in maintenance should come out of maintenance and start buying crude again. And as I touched on, I think it's going to be a very strong gasoline demand season in the US this summer. So the refineries there will start ramping up throughputs and starting to build stockpiles ahead of that driving season, which should give some positive impetus to tanker demand. Another short-term factor which may be positive is the recent wildfires that we've seen in Alberta. As we've seen, the fire there in Fort McMurray caused the evacuation of the whole town there of more than 80,000 residents. And it's also led to the shutdown of more than 1 million barrels per day of Canadian oil sands production. Now, whether that will impact on tankers will depend on the duration of the outage. If it just lasts for a week or two, then probably that oil, which normally goes down by pipeline to the States, they could probably just draw down on inventories. But if that outage lasts a little bit longer, say it lasts 2 weeks or a month, then we may see that the US has to import more crude by sea, and that would be positive for tankers. So we think that the outlook for the rest of Q2 looks pretty good on the crude tanker side before we get into the normal summer doldrums and the rates coming off into the summer months and into Q3 before another seasonal bounce up in Q4. Of course, as we've said before, We do see a bit more fleet growth coming in this year, and that will come more towards the end of the year. So that might impact on the rates as we get into the back end of 2016 and into 2017. But for the next three to 6 months, we think that won't have as much of an impact. And talking about the tanker supply side, we do see the fleet growth coming up this year and next. But the positive thing beyond 2017 is that there really hasn't been any new orders for tankers in recent months due to a lack of access to finance. And that means that once we get through this little stage of fleet growth in second half 16 and 17, we should be into a much better market again once we get into 2018. So even though the rates are a bit softer year on year and may come down again in 17, we don't see this as a severe slump in the tanker market, and we think that the market looks pretty strong again as we go into the final years of the decade. So that's our update on the conventional tanker market, and we'll speak to you again next month.